Ladies and gentlemen, today I want to talk to you about a concept that either makes you wealthy or leaves you wondering why others seem to get ahead while you stay stuck. The concept is control, and more specifically, control in investment. We all want financial growth. We want our money to work harder than we do. But here's the truth most people won't tell you. Growth without control is just noise. You might make money here and there, but you won't keep it. You won't scale it, and you definitely won't sustain it. I've seen too many people throw money into investments they don't understand, just because someone else is doing it. That is not control, that's copying. And copying without context is financial suicide. The first rule of controlled investing is knowing where every dollar is going and why. If you can't explain your investment strategy in one sentence, you don't have one. You're gambling, you must become obsessed with clarity, look at your statements, track your performance, ask questions, build the habit of understanding. Second, control is about discipline. Investment decisions made on emotions are the fastest way to lose money. FOMO is not a financial strategy, neither is panic. You need frameworks, not feelings. Smart investors move slowly but with certainty. They know that when the world is shouting buy, they should be checking fundamentals, not headlines. Third, controlled investment isn't about playing it safe, it's about playing it smart. Diversification doesn't mean scattering money across every shiny opportunity. It means placing your capital with intentionality in areas that align with your long-term goals. If you want passive income, your control should lead you toward assets that produce consistent cash flow, not just appreciation. You are the CFO of your life. Say it with me. I am the CFO of my life. That means no one, not your friends, not your broker, not your cousin who got lucky in crypto, should be in the driver's seat. You are in charge. You get to say yes or no, and that's power. Let's talk about ROI, not just return on investment, but return on intention. Every investment should serve your vision, not someone else's, not social media's, yours. You don't need to chase what's trending. You need to control what's building. So when I say control your investment, I'm not saying be afraid. I'm saying be awake, be alert, be aligned, because when you control your investment, you don't just grow your bank account. You grow your confidence, you grow your freedom, you grow your life. Control is clarity. When it comes to investment, this isn't just a catchy phrase, it's a fundamental truth. You cannot grow what you do not understand. The first step to mastering investment isn't jumping into the stock market or buying real estate or crypto. It's knowing exactly where your money is going right now. Every single dollar, when people say they don't have enough to invest, it's rarely because they truly don't have money. It's because they haven't taken the time to control their spending, track their expenses, and understand their cash flow. If you want to be someone who builds wealth intentionally, you need to build clarity intentionally. The truth is, most people avoid financial clarity because it makes them uncomfortable. They don't want to look at their bank accounts. They don't want to see how many subscriptions they forgot about, how much they spent on food delivery, or how little they actually saved last month. But here's what I tell my team, and here's what I want to tell you. Avoidance is expensive. The longer you delay taking control, the more opportunities you miss. When you refuse to look at your numbers, you're surrendering your power. You can't improve what you don't measure. So the first shift in controlling investment is becoming obsessed with knowing your financial landscape, down to the dollar. Think about it like a business. No successful CEO makes decisions without data. They have profit and loss statements. They have projections. They have real-time dashboards. Why? Because they understand that money is a reflection of movement, and to steer the ship in the right direction, they need to know exactly where they stand. You are the CEO of your financial life, and that means you need to track, monitor, and evaluate constantly. Every expense should have a reason. Every investment should have a goal. That's what clarity looks like. Now, clarity doesn't mean perfection. It means transparency. You're not aiming for zero mistakes. You're aiming to learn from everything. That one investment that didn't work out, instead of brushing it off, analyze it. Why didn't it work? What didn't you see? What assumptions did you make that turned out to be false? The more clarity you bring to your past decisions, the smarter your future ones become. Mistakes don't define you, lack of reflection does. There is a huge misconception that investing is just about taking risks. That mindset is dangerous. Smart investing isn't reckless. It's measured, it's calculated, and it's rooted in knowing your numbers. So, when I say control is clarity, I'm telling you that the real edge in investing isn't insider tips or timing the market. It's having a crystal, clear understanding of your own financial position. Do you know your net worth? Do you know your monthly cash surplus? Do you know how much of your income is being allocated to building assets versus maintaining lifestyle? These are not luxury questions. They are the questions that determine your financial future. Another powerful part of clarity is separating wants from needs. When you control your finances, you become ruthless about prioritization. You stop spending like everyone else and start investing like no one else. You begin to understand that every dollar you spend is a trade-off. You can't grow your investment portfolio if your consumption habits are growing faster than your income. Controlling your investments starts with controlling your mindset around money. It means thinking long-term instead of indulging in short-term gratification. If you truly want financial freedom, clarity must become your compass. That means you review your finances regularly, weekly, monthly. You analyze what worked and what didn't. You identify where you can cut, where you can invest more, and where you need to pause. You stop blindly trusting others with your money and start building the confidence to make your own calls. You seek knowledge instead of noise. You go from reactive to proactive. Let me say it again for the people in the back. Wealth doesn't start with how much you make. It starts with how well you manage what you already have. It's not about chasing bigger paychecks. It's about taking control of every penny right now, because when you gain clarity, you gain control, and when you have control, you gain power, power to grow, power to pivot, power to invest with intention. That's what changes your life, not a lucky break, not someone else's advice. Your clarity, your choices, your control. Measure risk, then move. That is the golden principle when it comes to investing with control. Too many people are moving before they measure. They're reacting instead of evaluating. They hear about a hot new opportunity, a trending stock, a booming real estate market, or a once-in-a-lifetime crypto coin, and they jump in without asking the most basic question: what is the risk? That single oversight can cost people years of hard work and financial momentum. If you want to build sustainable wealth, not temporary gains, you must train yourself to assess the risk first, always. The reason most people don't measure risk is because they are conditioned to chase reward. Our culture glorifies fast wins. The stories we hear are about people who made millions overnight. But what we don't hear are the thousands who lost everything because they didn't look before they leaped. Investment is not gambling. It is not a bet. It is a disciplined, methodical decision-making process based on data, logic, and long-term vision. So when you measure risk, you're not being cautious, you're being committed. You're showing respect for your money and for the effort it took to earn it. Understanding risk doesn't mean you avoid every opportunity that isn't guaranteed. Risk is a part of growth. But the difference between controlled investors and careless ones is that controlled investors know exactly what they are willing to lose, what they expect to gain, and how each decision aligns with their broader financial strategy. They don't just hope for the best, they prepare for all scenarios. That is what gives them the ability to move with confidence. The best investors ask tough questions before they ever move money. What is the worst case scenario here? Can I afford that loss? What is the time horizon for this investment? What external factors could impact the outcome? Is this decision being driven by facts, or am I just caught up in the excitement? If you can't answer those questions clearly, you have no business moving forward. Measuring risk is about facing the uncomfortable. It's about slowing down, stepping back, and analyzing with brutal honesty. Because the more prepared you are for what can go wrong, the more power you have to handle whatever happens. Another reason risk goes unmeasured is ego. People don't want to admit they don't understand something. They don't want to look like they're behind or that they missed an opportunity, but here's the truth: ego will bankrupt you faster than any bad market. When your pride is bigger than your preparation, your money will vanish. Controlled investors are humble enough to pause, ask questions, do research, and walk away from deals they don't understand. Saying no is not a weakness, it's a power move. Risk isn't just about losing money. It's about losing time, energy, and focus. Every investment comes with a cost, and you need to assess all of it. Some investments might offer decent returns but drain your time and create stress. Others might seem exciting but take your focus away from what really matters. Controlled investing is about keeping your priorities straight. You don't just chase the numbers, you consider the full impact on your life. How does this fit into your overall plan? Does it align with your goals, or is it just a distraction dressed up as opportunity? When you measure risk, you also protect your momentum. Too many investors get excited, go all in on something risky, and then when it fails, they retreat from investing altogether. One bad decision shakes their entire financial confidence. That's not because investing is bad, it's because they didn't prepare for the downside. They didn't build in safety nets. Measuring risk means you put buffers in place. You don't invest what you can't afford to lose. You don't rely on one vehicle to make you wealthy. You diversify based on understanding, not fear. That is how you stay in the game long enough to win. Controlled investment is a balance between courage and caution. Measuring risk allows you to step forward without falling off a cliff. It gives you the information to move strategically, and when you move strategically, you move faster, not because you rush, but because you're ready. You're not second guessing. You're not chasing every trend. You're playing your own game, and you're playing it with intelligence. So every time you feel the urge to jump into an investment, pause, measure the risk. Look at the facts, run the numbers, test your assumptions, and then, only when you've gathered the full picture, move. That pause might take hours, it might take days, but it will save you years of regret. You don't need to be first, you need to be right, and that begins with control, rooted in clarity, backed by calculation. That's how you build wealth that lasts. Emotion has no seat at the investment table. If you want to control your investments and build lasting financial success, you must learn to separate how you feel from how you decide. This is where so many people get it wrong. They allow excitement to push them into risky ventures and fear to pull them out too early. Both reactions sabotage long-term growth. Controlled investment isn't just about where you put your money, it's about how you think, how you respond, and whether or not you allow emotion to override logic. Let's talk about excitement first. It's natural to feel energized when you discover a new opportunity. Maybe a friend is raving about a booming industry, or you hear a success story that sounds too good to ignore. The numbers look attractive, the pitch is persuasive, and your adrenaline kicks in. That rush of enthusiasm can feel like certainty, but it isn't. Excitement is not a green light. It's a red flag telling you to slow down and verify. Smart investors know that emotional highs often cloud judgment. They pause, they analyze, they dig into the facts before making a move. Controlled investment means asking, is this really a smart decision, or am I being swept away by the story? The opposite side of the emotional spectrum is fear. Fear is powerful, and in the world of investing, it shows up in two ways: fear of loss and fear of missing out. Fear of loss can paralyze you. It convinces you that staying out of the mark, it is safer than participating. It makes you doubt your research, your strategy, even your capability. Controlled investors don't ignore fear. They acknowledge it, but they don't let it dictate their choices. They use it as a signal to double, to check the data, not to walk away from every opportunity. Then there's fear of missing out, FOMO. This one is sneaky because it often disguises itself as urgency. You see others making money, you see trends rising fast, and you think, if I don't act now, I'll lose my chance. That is not strategy. That is panic dressed up as ambition. FOMO has led more people into bad investments than any recession or market crash. Controlled investment means being confident enough to say, I will not chase, I will choose. You don't need to catch every wave to win. You need to ride the right waves at the right time with full awareness. The emotional roller coaster doesn't end with decision making. It follows investors through the entire life cycle of an investment. You buy a stock and the next day it drops, panic sets in, you question everything or it rises and greed creeps in. You want to buy more, risk more, double down. The emotional swings are endless if you allow them to control you. That's why you need a plan before you invest. Not just a strategy for entering, but a strategy for holding, for adjusting, and for exiting. When your decisions are based on predetermined logic rather than reactive emotion, you take back your power. You become a builder, not a gambler. Controlled investment means creating emotional distance from your money. It means remembering that your net worth is not your self-worth, that the market's movement is not a reflection of your intelligence, that a temporary loss doesn't make you a failure and a temporary gain doesn't make you a genius. When you detach emotionally, you're free to think clearly, act decisively, and stay consistent even when things get hard. There's another layer to emotional control that's often overlooked: personal attachment to outcomes. You might invest in a business idea because you love it, you believe in it, it aligns with your passion. But passion alone doesn't make something profitable. Controlled investors understand that belief is not a substitute for performance. You can support something emotionally while still making financial decisions logically. That separation is crucial. If the numbers don't support your belief, you don't invest. It's that simple. To invest with control, you must first control yourself. You must train your brain to override emotional responses. This isn't something that happens overnight. It's a skill developed over time. It means practicing pause before action. It means reviewing decisions and learning where emotion played a role. It means building systems and structures that anchor your choices in reality, not reaction. In the end, controlled investment is about mastering the mindset. If your emotions are making the decisions, you're not in control, your impulses are. But if your principles, processes, and preparation are leading the way, then you are in command. And when you are in command, you stop reacting and start building. You stop chasing noise and start creating legacy. That is the difference between temporary success and sustainable wealth. Emotion may belong in many parts of your life, but when it comes to investment, it has no seat at the table. Diversification is often talked about like a golden rule in investing, but diversification without purpose is just noise. Throwing your money into a variety of assets without clarity or intention isn't smart, it's scattered. True diversification isn't about having your hand in every opportunity just to feel safe. It's about aligning every single investment with a vision, a strategy, and a result you're building toward. Purposeful diversification means you don't just spread risk, you direct your capital like a general deploying troops. Every move has a reason, every dollar has a job. The mistake many people make is thinking that more means better. They put money into 5 different businesses, 3 crypto platforms, some real estate, and a handful of stocks without any cohesive plan. That's not diversification, that's distraction. When you invest without purpose, your money might be working, but it's not working together. There's no synergy, no focused outcome, no defined metric for success. It becomes impossible to track progress or improve performance because there's no clear strategy behind the choices. You're reacting, not building. And building is what investing is about. Purposeful diversification starts with knowing your goals. Are you looking for long-term appreciation or immediate cash flow? Are you building generational wealth or funding your freedom within the next 5 years? Are you optimizing for security, growth, or influence? You must answer these questions with absolute clarity because your investment decisions should reflect them. If your goal is financial freedom in the next 5 years, your portfolio needs to reflect that urgency. That means leaning into income-producing assets and low-volatility investments, not just what's trending. Your investments should be rooted in outcomes, not options. One of the most powerful things about controlled diversification is that it balances your mindset. When you place investments with purpose, you avoid emotional overcommitment to any single venture. You're not crushed when one thing underperforms because you have other areas that are aligned and resilient. But more importantly, you don't allow one hot investment to derail your focus. Controlled investors don't chase, they allocate. They study patterns. They understand the difference between high risk experiments and stable growth engines. And they place their capital accordingly. You also need to diversify across time horizons. It's not just about what industries or assets you're invested in. It's about how those investments mature over time. Some will grow slowly but steadily. Others may be short-term plays that carry more volatility but offer faster returns. Controlled investors layer their investments so they're not overly dependent on any single event or timeline. They position themselves so that whether it's 12 months or 10 years down the road, something in their portfolio is always maturing. That's how you create financial rhythm. That's how you stay in motion without burning out. Another important element of purposeful diversification is skill-based investing. Many people overlook this. They separate their money from their strengths, but your best investments often lie in areas where you already have knowledge, influence, or insight. If you understand an industry deeply, invest in it. If you've spent your career building systems, find businesses where you can add operational value. When you invest where you are skilled, you de-risk your capital because you bring more than just money to the table. That's not just diversification, that's leverage. And let's not forget that diversification is also about who you partner with. Don't just spread your money across asset classes. Spread your risk by choosing trustworthy operators, aligned collaborators, and transparent platforms. Ask questions, do the research, evaluate character and track record just as much as numbers. A smart investor doesn't just diversify assets, they diversify exposure. They reduce their vulnerability by increasing their understanding of the people and systems involved. Purposeful diversification means you never invest just to invest. You don't do it because someone else did. You don't do it because the internet says it's hot. You do it because it fits, because it serves your bigger picture, because it moves you towards something meaningful. That kind of clarity transforms your entire relationship with money. You stop trying to be everywhere and start focusing on being exactly where it counts. When you diversify with purpose, you're not just investing, you're architecting. You're designing a financial foundation that doesn't just hold up under pressure, it adapts, evolves, and accelerates your vision. That's what control looks like. Not chaos disguised as action, but strategy backed by intention. You don't need 100 investments to succeed. You need the right ones, working in harmony, aligned with your purpose, and managed with discipline. That's how real wealth is built. Not just scattered but structured, not rushed but rooted, not reactive but relentlessly intentional. ChatGPT said, "You are the CFO of your life." That means whether you like it or not, you are in charge of every financial decision, every opportunity taken or missed, every dollar earned and spent. The moment you accept this truth, you reclaim the power that so many people unknowingly give away. Too often, people hand over responsibility for their financial future to someone else, a spouse, a financial advisor, a market trend, a headline, or even luck, but no one is coming to save your bank account. No one is going to care about your wealth more than you. That's why stepping into the role of Chief Financial Officer of your own life is not optional if you want real freedom. It's essential. When you step into this identity, you stop blaming the market, the economy, or your circumstances for where you are. You start looking at the facts and owning your decisions. A true CFO doesn't make excuses. They look at the numbers and they take action. That's what you must do. Look at your income, your expenses, your investments, your debts. Where is your money going? What is it building? What is it costing you? Most people don't ask these questions because they're afraid of the answers. But leadership requires courage, and if you're going to lead your financial life, you must be willing to confront reality with clarity and strength. Being your own CFO means more than tracking numbers. It means setting a vision. No business would operate without a financial plan, a forecast, and a strategy for growth. Yet individuals do it every day. They drift from paycheck to paycheck, reacting instead of directing. But a CFO doesn't drift. A CFO sets targets. You need to know what you're working toward, not vague hopes like "I want to be rich," but specific outcomes like "I want to generate $10 zero in passive income within 3 years," or "I want to retire with $2 million invested across multiple cash flowing assets." These kinds of targets give you direction, urgency, and a framework for decision making. As CFO, you must also embrace education. You wouldn't expect a corporate CFO to make sound decisions without knowing financial principles, tax laws, or investment fundamentals. So why do we expect to succeed in our personal finances while avoiding financial literacy? It's time to close the gap. Learn about budgeting, cash flow, asset allocation, and tax strategy. Read books, listen to experts, ask questions. Build your financial knowledge like your future depends on it, because it does. The more you understand, the more confident and in control you become. Control means knowing not just what to do, but what not to do. It means saying no to impulsive purchases that feel good in the moment but weaken your long-term position. It means ignoring pressure to keep up with what others are doing. As CFO, you must become strategic with your money. Every dollar should either grow your wealth, protect your wealth, or increase your freedom. If it doesn't do one of those three things, it doesn't belong in your plan. That's the kind of intentional thinking that changes lives. One of the most powerful parts of taking on the CFO role is learning how to make unemotional decisions. Most people spend based on feelings, how they feel when they buy, how they feel when they lose money, how they feel about risk. But emotions are not metrics. They don't belong in your financial plan. A CFO relies on data, on logic, on outcomes. When you remove emotional reactions from your money and replace them with disciplined strategy, you elevate your decision making to a professional level. Let's not ignore the people aspect of this. Being CFO doesn't mean doing everything alone. It means leading. It means knowing how to delegate wisely, work with advisors intelligently, and build systems that support your vision. But leadership still starts with ownership. You can hire experts, but they can't replace your responsibility. They can help guide your choices, but the direction must still come from you. No one else can define what financial freedom means to you or how you plan to get there. Finally, being the CFO of your life is about legacy. It's not just about building for today, it's about what you're leaving behind. It's about creating options for your future and opportunities for the people you love. When you step fully into this role, you stop living in reaction and start living by design. You stop hoping and start creating. You begin to think long-term, act decisively, and hold yourself to a higher standard, not just because it's smart, but because it's who you've decided to be. You don't need a degree in finance to lead your financial life like a CFO. You just need a commitment to clarity, consistency, and control. You need the courage to look at the truth, the discipline to act on it, and the vision to build something bigger than a bank balance. When you own your role as the CFO of your life, you stop waiting for success and start becoming the architect of it. That's real power, that's real control, and that's how financial freedom is truly built.